Hello everybody, welcome back to the Finance Channel. Today we are going to talk about a very interesting topic called inflation. As you can see right here on the homepage of Yahoo Finance, we can see that inflation has hit a 40-year high of 7.9%. So if this continues, then we might actually see 8 to 10% inflation for the entire year, which means that your money has basically lost 8 to 10% of its purchasing power that year. You can buy 8 to 10% less stuff with it. Now, the reason why inflation has been rising like crazy is mostly because of two things. Well, actually three. First of all, it has been rising because of the Federal Reserve, the central bank of the United States of America. They have been printing money, have made borrowing extremely cheap, and they've also been shoving cash into the hands of people directly. And also, the government has been taking on a lot of debt. So a lot of cash creation from the government's end, you know, and all that new cash is still chasing a limited amount of goods, which leads to inflation. Now, the second reason is COVID. It hit a lot of supply chains and it made certain things rather difficult. However, those things are mostly behind us now. And the third thing is the war in Russia and Ukraine, with Russia taking over Ukraine and everything. Like, both those countries produce a lot of important things like nickel, palladium, and platinum, which are used in electric vehicles for the batteries, for example, batteries in general, a lot of electrical components, industrial components, like the exhaust of your car. And aside from that, they also produce a lot of wheat, which is used for bread and other baked goods and a lot of dishes in general. So that will also affect food prices. So that's another reason why inflation has gone kind of nuts. But so far, we haven't really felt that yet. Like, more of that is coming soon, or is happening as we speak. However, today we aren't necessarily going to talk about where inflation is going. We are going to talk about what you could do in order to fight inflation. As we all know, holding cash is not going to work for you. Your cash will just lose value as time goes on. So you gotta invest it somehow. But what options do you have in such an environment where prices go higher and higher and higher? Well, let's have a look at that. Now, for our first option, we will be looking at commodities. Now, when I'm talking about commodities, I'm talking about oil, gas, silver, gold, wheat, sugar, like anything that is considered a raw product, a raw material that is used to create other stuff. Usually, these are quite a good bet because a lot of the money also ends up in those raw materials. A lot of that spare cash is used to buy up those raw materials, which pushes up the price if enough people throw enough cash at it. Again, supply and demand, basic economics. Now let's start with our first commodity here, which is oil. In the beginning, oil went down incredibly fast and hard. Mostly because people stopped going outside because there was a pandemic, so nobody went flying, nobody used their car anymore. So the demand for oil was gone, and storing oil is expensive, and oil doesn't last forever, just like gasoline doesn't last forever in a car. And so the prices went down incredibly fast. But then, as people went outside again and had the urge to do stuff, there was an explosion of demand for oil. Because all of a sudden, people started driving again, planes started flying again, and so there was a huge demand. Secondly, there was a lot of cash all of a sudden, because the government had been throwing out cash like crazy, and production also kind of slowed down because of pandemic issues, and also because they couldn't sell that much of it, so then you're gonna scale down production again. And so oil shot up, and Russia, the whole Russia conflict made this worse because of the fact that they produce a lot of oil. So if you bought oil actually as an inflation hedge, as you can see from 2021, it especially went crazy when inflation really shot up, it would have actually been a very good bet. But sadly enough, at this point, I wouldn't really advise anyone to buy oil anymore because it's already quite high. We're already talking about an oil price of 107. The maximum we have ever seen historically is 180. So, oil is a bit expensive, but it would have been a good inflation hedge. And historically speaking, oil has always been a good inflation hedge. In general, oil always goes up when the government either starts printing money or inflation really picks up. So, in a lot of instances, oil is a good bet. But at this point, it's just too expensive. However, we're gonna look at another commodity that might be worth it. Now this is another classic. Gold. Everybody knows gold, everybody wants gold. Gold, gold, gold. The real money, as some people would say. It kinda is, but it also isn't. Money is just a social construct. Gold has no value at the end of the day. It's not used for a lot of industrial things. I know there are a lot of like pro-gold people out there that will tell you like, I know gold is used for a lot of stuff. But no, it isn't. Gold is mostly used for jewelry. Aside from that, it has no use at all because it's way too expensive and we found better alternatives. Like in the 70s, gold was used for computers and stuff. Nowadays, it's barely used for that. However, gold is forming a nice pattern. Historically, it's an amazing inflation hedge. It isn't always the best crisis hedge, but it is a very good inflation hedge. If you look at gold right now, you can see it's forming what they call a cup and handle pattern. You can see it goes up, it forms the bottom of the cup here, and then it creates a handle here. And as you can see, I drew a line here, which is the breakout point. If it goes above this line, it completed the cup and handle pattern. And usually a cup and handle pattern goes from the bottom of the cup to the top here, which is in this case around $850. It will rise $850 from this line. And there's historically speaking, a 68% chance that this will happen. So statistically, it's in your favor. If it actually does play out this pattern completely, we will most likely see a gold price of around $2,700 to maybe $3,000 if it overextends a bit from this cup and handle pattern. So personally, and actually I did this already quite a while ago, I opened a position in both silver, because that kind of mimics gold in a lot of ways, and silver has more industrial uses than gold. And I also bought shares of a mining company called PAS, Pan American Silver Company. They mostly mine gold and silver, and they are in quite good financial shape. They had a bit of a rocky 2021 and 2020 so far, but they have a lot of money, they have good growth, good track record, a good balance sheet overall. I talked about this in my value investing beginners kind of guide video. It's on my channel. I'll put a link down below. But like from a cash flow perspective, it looks quite good, quite consistently growing, with exception of this year because they had a lot of extra expenses in 2021. Again, they can miss one or two, but overall it needs to be a nice trend in a positive manner. And overall, PAS is one of the better mining companies out there. So personally, I bought this hedge by buying shares in Pan American Silver Company and buying the silver ETF known as SLV, iShares Silver Trust. I also bought this a while ago. In my opinion, both of them are quite decent inflation hedges, and we have seen in the past with gold that it really does well during inflation. Now, right here, you can see the gold price over the last 100 years. Everybody knows that in the 70s and 80s, we had a lot of inflation, like huge levels of inflation. And as you can see, gold and silver, both actually, did incredibly well during this time. This is the gold chart specifically. And then in 2008, we had the financial crises. And you can see that gold actually was already rising before that, because gold can actually go up in tandem with the stock market. Gold doesn't only go up when the stock market goes down. Gold and the stock market can both go up. But you can see that gold went up, and then when 2008, the financial crisis happened, it actually dropped quite a bit, and then it continued to make a gigantic run all the way up to around $2,200. And we actually saw the same thing again during the Great Depression in the late 1920s, where it went from around $300 to over $700. But then, because it isn't the perfect hedge to be honest, it actually went down during World War II. As you can see during here, World War II started around here, 1940, and it went down. And even during World War I, which was 1914 to 1918, it also went down tremendously. So while gold is a good hedge for inflation or monetary crises, it isn't necessarily a good hedge for war. In a lot of instances when there is actually a war, gold goes down. Gold doesn't do well during turmoil. It's surprising that it's doing so well during the whole Russia-Ukraine conflict, but that might also be because people are uncertain about the financial situation and mostly inflation, but they aren't the only option. Another option we have is real estate investment trusts. Also, this website that I'm using right now called Investopedia is great if you want to look up certain terms or certain things in the stock market or finance that you don't understand. They have very good explanations and even small videos that explain it. It's great. But REITs are real estate investment trusts. So they are basically companies that buy up real estate and then lease it or lend it out or whatever. They do stuff with the real estate. Overall, they are good inflation hedges because property usually holds its value and also grows tremendously fast during times of inflation, as we have seen in the last year as well. Housing prices have absolutely exploded as well. And aside from that, they actually have a direct form of yield from the income that the properties are making by leasing or lending them out. So they get money from the renters, then a part of it goes to the company and is used to maintain the company or grow the company or finance debt, and then a part of it gets sent to investors. So if you own shares in a real estate investment trust, you will most likely get a dividend, a decent dividend, usually 2 to 4% a year. And obviously the fact that the real estate appreciates in price and therefore the shares of that real estate investment trust go up. So you get cash from the company direct to your account and the shares go up in value. So you make money two ways. Now, this is a very good hedge. Don't get me wrong. Real estate is a very good hedge. But there's one problem with real estate. A big problem with real estate, and especially REITs, is that they usually have a lot of debt. And that has gone badly before. And this article from MarketWatch actually covers that perfectly. As you can see here, this is a little simple overview. Again, I will link this article down below. If you can't get access to it, because again, article limited, download the Brave browser, go up here and open a private window with Tor. Then it works perfectly. But as you can see, during 1971 to 98, which to 81, I mean, which was a period in time where the USA had a lot of inflation issues, you can see that REITs actually did pretty well. And oil also did amazingly. However, there's one problem with REITs, and they also cover this in the article down here. And that's, in 1973 and 74, if I remember correctly, like around those years at least, there was a huge crisis in REITs because a lot of them had too much debt. And all of a sudden, when the government started to fight inflation, which they usually do by increasing the interest rate, so they make borrowing more expensive, REITs can run into problems because all of a sudden borrowing becomes a lot more expensive. Sure, it takes a while before that actually hits those companies, you know, because only after so many years they have to renegotiate their contracts, but like 5 to 10 years down the road, a lot of REITs were having trouble because in the 60s, they already started increasing interest rates. And like in 69 and 68, they already hit quite a high number and the REITs got into a lot of trouble. For example, right here, you can see the Fed funds rate. So that's the interest rate that the central bank sets for the banks that are lending from the central bank. It's kind of a two-step system. So you have the central bank who are lending money out to normal banks, so the banks that we interact with as consumers, and those banks then lend it out to us. Central bank, normal bank, us. As you can see, here the interest rates were quite low, from 1% to 3%. Still, that's quite high compared to what it is now, because interest rates are at the moment basically zero. But as you can see, from 62 onward, they started raising interest rates. And a lot of real estate investment trusts, like a lot of REITs, got into trouble because just the interests were getting too high and they got quoted new interests and they just couldn't pay it. And like a lot of consumers and a lot of businesses got in trouble as well because of the inflation and the increased cost of borrowing. And so a lot of the buildings they were renting out were losing people, so they were empty, but the amount of interest they had to pay on their loans was increasing, which is a recipe for disaster, to say the least. And for the people who are wondering, why are they doing this then, if this also hits consumers and like businesses and whatever, this is the only way to stop inflation. If you want to stop inflation that is caused by too much money, you need to limit the amount of money. You need to limit government spending, you need to limit borrowing, you need to stop printing money, basically, and putting money into the system. You need to just stop, you know? And then down the road, it gets better, and then you can lower it again, but it's usually a delayed reaction. So what you need to look at is REITs that have good financials or are located in a sector that is very resilient. And I'm going to show you one great example that I bought into. Now, this is a company known as American Tower, and they are also a REIT, but they have quite a special niche. They don't actually own buildings. Well, they sometimes own buildings, but what they mostly invest into is radio towers and like communications towers. They are in 6 different continents, 25 different countries, and they have 220,000 different radio towers, or 4G or 2G, 5G towers. As we all know, that's incredibly important in our infrastructure. And there is a high chance, actually, it has been proven, that this company does incredibly well when there is a crisis. Because no matter what happens in the world and everybody loses their money and the stuff goes really sideways and the economy goes down bad, you would still need data. You still need to text people. You still need to call people. You still need to use internet of some kind to do anything. A lot of devices are also interconnected nowadays. For example, your Tesla car is also needs some form of 2G, 4G, 3G for a lot of its updates and other things. So one thing we can see with this company, they do incredibly well during a crisis. And we saw this in 2008 as well, when cell phones and 2G, 3G, 4G, 5G didn't even exist yet. Like, people didn't have 3G on their phone yet. They couldn't browse the internet with their BlackBerry in 2008 and 2007. The demand wasn't even there yet at this point, but American Tower grew by 8% during that time, even though 2008 was a financial crisis that mostly hit REITs and buildings and real estate in general. And even in 2009, 10, and 11, they were still growing, and I will show you. Alright, right here we can see the income statements of American Tower. This is a website called Macro Trends, also very nice. Right here, this is 2009, and if you look at revenue, you can see that at the end of 2009 they had 1.7, then they went to 1.9, to 2.4, 2.8, 3.3, 4.1. They were still growing even directly after the financial crisis that really lasted until 2010. Even their net income was still rising most of the years. Like, it was quite consistently still rising. And if you look at their statistics, they do have 52 billion in debt, but they have 2 billion in cash in the back, and they also have a pretty consistent income that's not really hit by any horrible events like Corona, for example. Even in Corona, their operating cash flow, which is the money that goes towards operations, they usually want to see this go up. That's a good thing. It went from 3.7 to 3.8 to 4.8. It just went up. And even their free cash flow, you can see their free cash flow didn't even go down. And free cash flow is literally money they have on the side. It's just not money that's not necessarily being used. But we have one more potential hedge that might even be better than American Tower, but you need to have some knowledge. Now, for our last hedge, we will be looking at cryptocurrency, which is a new thing, but it has some advantages. One of them, for example, being the monetary policy is set in stone usually and doesn't change that much. The inflation rates of a lot of cryptocurrencies, especially Bitcoin and Ethereum, are very low, around 1 to 2%. You know, while the current inflation in America is heading towards more like 7 to 10. And last year it was already 4.7, 4.8. And the inflation rate of currencies like Bitcoin is only gonna go down and down and down, and there's a limited amount. And Ethereum also is going to change some things and is going to go over to Ethereum 2.0, which changes the consensus model. So it goes from proof of work, which is mining with a lot of computers and electricity, very power consuming. It goes over to what they call proof of stake, where you stake your coins and then you have the right to validate transactions. And if you do something that harms the network, your tokens or a part of your tokens or coins will be taken, so they will actually take money. Because of that change, Ethereum will actually go negative for its inflation. So the amount of Ethereum, which is currently almost 120 million, will actually go down. If you go to a website like Statista, which is another great website, by the way, a lot of these websites that I'm giving you are like amazing for finding statistics. You can see that the inflation rate of Ethereum has already gone down a lot, and it's actually quite steady now. It's only 1% actually at the moment. But when they go over to proof of stake, the inflation rate will go down even more and it will go negative. So it's actually truly deflationary at that point, which again is good for the price, especially if the American dollar, the euro, and everything will have high inflation. But this isn't the only thing. There are more things you can do with Ethereum and Bitcoin, stuff like that. In the modern world of cryptocurrency, you can actually do something called DeFi, which is decentralized finance. As we all know, a lot of blockchains and cryptocurrency projects are permissionless networks where you can exchange coins, tokens, money, value. You can do a lot of things. And Ethereum also created something called smart contracts, which are automatically executable contracts run by artificial intelligence. They work incredibly well and they barely have any faults. Sometimes it goes wrong, but it's very rare, especially on established, developed platforms. So what you can do is you can also take your money and you can put it in what they call decentralized finance. I have a decent amount of money in this. I'm also very much interested in it. This is a very promising field, sector that's gonna grow incredibly big and might even get bigger than traditional finance, because you cut out a lot of middlemen with this stuff and it's very easy to use. For example, here on this website called Bancor, this is a project that has also existed for a very long time, and this is a DeFi project. So they mostly focus on facilitating all this stuff, and they also have their own native token, which is used to collateralize a lot of stuff on the platform. You can, for example, stake your money. Let's say your coins are like water, and you have a gigantic bathtub. You throw your water into the bathtub, and other people can take that water and do stuff with it, and you get paid for them borrowing your money. You basically get interest. It's just like how back in the day, doesn't really exist anymore because of the low interest rates. Back in the day, you got a lot of money for putting your cash on a bank account. You got a yearly interest on it. Nowadays, that's kind of gone, but here on DeFi applications, you can get very good interest rates with a low risk. For example, on Ethereum, you can get a 4.5% interest rate, and it's collateralized by Bancor, because usually they come in pools. There are usually two things in the pool. So you can go from Ethereum to Bancor, from Bancor to Ethereum. This is something I might explain to you all later. It's called impermanent loss. It's a bit complicated. That's for another time. I'll put an article to it down below, but it's rather complex. It takes a little bit of effort to wrap your head around, but once you understand it, it's quite easy. And you can also put USDC, DAI, and USDT, which are dollar stablecoins on here, and get a whopping 28 to 24% interest a year on it. And again, it is very low risk. I would personally give it a risk score of 2 out of 10, especially if you spread it across a lot of different platforms, not just one. And there are more like these. You could also go for something that is easier to use. For example, you have this platform called Nexo, which is also quite a good one. Again, like, this is an exchange, so this is a place where you would use your bank card or credit card and buy cryptocurrency. And it is actually insured. And it uses ledger technology to safeguard your crypto. But again, you can also stake your crypto here and earn money on a lot of assets. You can earn 12%. Well, if you earn in Nexo, that's their own currency. I wouldn't necessarily do that. But if you do earn in kind, then you earn in the same token that you put in. You can earn 10% on USDT, USDC, DAI, which is all just stable coins, so they reflect one-on-one the price of the dollar. You can get 6% a year on Ethereum. You can get 6% a year on Bitcoin for doing absolutely nothing. And again, if you spread it across a lot of platforms, and there are quite a lot of them, and a lot that have existed for a long time and are also certified by banks and very well developed, like Nexo. Or here, for example, Crypto.com, another great one. These guys also give you incredibly good rates. And another one we have is PancakeSwap. This is another one that I use. But this is very much worth it. This is another great inflation hedge because you can get a consistent, reliable return. that is backed by actual use cases of people borrowing money to do all kinds of complicated financial things like arbitrage, and I could explain all of this, but there is a reason why people borrow money on platforms like this. This is basically my last idea for an inflation hedge. And the biggest takeaway from this is you have to do something about it. If you don't do anything about it and you don't invest your money, you are just losing money every single day, every single year. And wages never keep up with inflation. Wages are always slow. They are always behind inflation. So this was my little video on inflation. If you have any questions, leave them down below. I know it was a bit of a long one, but hey, it's very informative and it gives you a lot of links to good websites and good places you can do your stuff. Always double research any of the things I said. Always do your own homework. Make sure you understand what you're doing. And again, diversify. Don't put all your eggs in one basket. A lot of links to these websites and other things will be down below in the comments section, in the description, I mean. So go check them out, and I hope you enjoyed this video. Be sure to subscribe, click the bell button and everything, and subscribe and like, and tell me in the comments what you want to see next. Yay, I'm gonna do more finance videos.